Okay, good evening guys. Before we get started, as always, let's do the customer instant poll. Actually, new microphone tonight, so let me just know if the sound's coming through perfect, too loud or too low. So should be standard-ish settings. It's just another headset, so it should be absolutely fine. Okay, majority of people saying perfect. Good enough for me. Thank you. Well, interesting day in the markets today. Some interesting comments out of the Eurozone and Greece. Not a great trading day for me, I'll be perfectly honest. I was heavily short the DAX when that comment came out, so had to endure a little bit of pain. And then obviously we just had the comments out of Canada saying that they're probably going to move on rates and they're not quite sure where they're going to go. So we've seen a lot of recent strength come into the dollar. Dollar versus the CAD is up heavily, and I was long the Aussie dollar and got out for a measly profit. So not a great successful day's trading, but never mind. These things do happen. So we're going to continue the Trade for Life course tonight. This is the final part now. So we're going to talk about trend tools and oscillators and technical analysis. So this kind of does round up the course now. It brings us, a full circle to everything that I think we need to be able to get involved in the markets, to understand why we need a trading plan, the theory behind it, all that kind of stuff. And now what we're trying to do is put the individual building blocks, all the 20% of fundamentals that I say are so important, all the technicals that the market, really does rely on, be it the support resistance, the indicators, the oscillators, all these different parts. And really, now once we've got this final part underway, it's all about bolting these together and then watching the live sessions and watching the individual webinars just to see where everything else slots in. So should have a good grounding. As I said, I've run this course for a long time now, so it should be, should be a good foundation course for everybody. I'm working on the new Art of Trading course, which will be rolled out very soon, and that's really the kind of next step from this. So before I start, as always, the risk warning. Remember that spread betting, CFD trading, carry hard risk or capital liquidity and losses to deceive your initial deposits. Remember, suitable for all investors, so please ensure you fully understand the risks involved. The information comments provided here under no circumstances consider officers a solicitation of invest. Nothing here should be issued investment advice. The information provided will be accurate the date it is produced. Education only. Content of webinars posted of the moderator, not trader.com. Content does not constitute financial investment or tax advice. Trader.com does not accept any liability for the content of comments made during the session. So the use of trend tools. So trend tools really are a secondary aid. So the calculation is based upon various measures such as volatility, volume, open interest, and momentum. So really for me to give additional information to the market sentiment, and obviously you've got the underlying tone of the market, be it fundamental, bearish or bullish, or be it, from a technical standpoint, making higher highs, making lower lows. And really these other indicators are just another measure of gauging if the market's overbought or oversold. And that's the only real way we can understand what are the traders that are trading technically are actually looking at. So you look for the overall direction of a market, and that's fairly easy to establish. You're either buying or selling. The market's either moving up in an uptrend or a downtrend. And then we've got the oversold and overbought territories, which can be, again, above or below the moving average. They can be the upper or lower boundaries of the Bollinger Bands. They could be the RSI, MACD, Stochastics, Parabolic SAR, anything that adds a little bit of technical flavor to the charts. I guess you can say it's like a secondary tool, and they're generally there to help us, form the buy and sell signals, but they have to be part of the bigger picture. A lot of people think that there's some magic secret scenario where you can use, an indicator or a series of indicators to get perfect signals, and it just doesn't exist. And from literally years and years and years and years of speaking to traders, quant traders, very mathematical traders, I know hand on heart there's no perfect formula out there. From developing my own strategies, my own trading signals, it's so very hard to put the way I trade on a day-to-day basis into a set calculated formula. So really what we're always trying to do is balance out that 20% fundamental to get an idea of what the market could potentially base decisions on. And then we're looking for the trend, as we know that's your friend, and then we're trying to bolt on these other indicators and oscillators, which is just essentially the same thing, and just trying to figure out, where the market's either continuing or turning. So oscillators are used in a ranging market, okay? So an oscillator is different. Well, it is no different than an indicator, okay? An indicator is something you see in your screens that gives you an idea of what a market can achieve. So an indicator is a Bollinger Band, They are indicators. They're shown on your screen, show you two standard deviations around a moving average, and show you overbought and oversold territories. An oscillator is exactly the same. It is an indicator on your screen, but it's generally displayed outside the chart. And also, instead of being, well, it is also visual. But what it does, it shows you how the market is moving in a range. So between 0 and 1, okay, and 0 and 100. That is how the market shows you when we're overbought and oversold. So I'd say the most common tools and trend tools that we use in trading are the moving average, Bollinger Bands, RSI, the relative strength, Parabolic SAR, and Fibonacci. So when adding these trend tools to the charts, it's all about the balance, okay? We need to understand that things on our charts we don't look at are no use to us. If we don't look at them and use them for a trading indication, an idea to get in, to get out, then there's absolutely no point in putting them on your charts. They might work once, and again, if you then discount them and never use it again, then what's the point of going back to it? You need something that every time you want to press the button to trade to get in or out, you should be checking these trend tools and seeing exactly what is, the market is trying to achieve, what is useful to you. So if you kind of put everything on your charts, it doesn't look too bad. But if you just use a standard intertrader chart and you put the Bollinger Bands, the RSI, MACD, you put Fibonacci on, you're generally going to get, quite a confused chart. And what I like to do is look at different correlating markets. So if I'm trading the FTSE, for instance, I'll be looking at the S&P, I'll be looking at gold, I'll be looking at the DAX, and these markets will be side by side. So if you've got every chart with all this kind of information on, you can only fit a limited amount of charts on your screen. So I would say that having other correlated products, indirectly and directly correlated products, is a wise kind of charting setup. And every time you watch non-farm payrolls, I will have 2 or 3 charts up. I'll have charts on different time frames. There'll be different setups according to what I'm trying to achieve. So again, for intraday trading, you have to remember that the oscillators and indicators that you use will be on different time frames. So you don't want to just necessarily look at everything on a 15-minute chart. Maybe you want a 15-minute chart versus an hourly chart, or a 5-minute chart versus an hourly chart. Again, you don't want to look at everything just on one single time frame. So when we look at volume is the total number of contracts that are traded and bought and sold during a specific time frame. So a lot of people ask me, what do I use for volume? What's my volume indicators? And to be honest, because I'm not a direct markets, access trader anymore, the volume doesn't really make that much difference to me. We can't really get in at the price we want because we're trading a spread. And, the flow and the contracts that go through each individual price are just irrelevant to the average trader that's a spread better. So unless you're trading in a very, very specific way, you don't need to know the volume of what goes through at each price. What you can determine the volume by of the markets is by the size of the candles. So if you've got a big green candle, that's a buying day, okay, or a buying 15-minute or a 5-minute. If you've got a red candle, it's selling. So I do it visually by using the candlesticks. So it doesn't really matter to me what the volume is going through each price. If I see big candles, then I know there's volume in the market and people are trading. If there's big wicks, I know there's less volume but more volatility, because what the wicks show you is that prices are missed out and prices are traded very, very quickly. And that means there's lots of volatility, but not volume, because not everybody's trading at the same price. But if you see a big fat green candle or red candle, and it's got that solid body, that means every price is traded between the highs and the lows. So that's just how you tell volume. So moving averages. Now these are the most commonly used trend tools, I guess. I would say every trader in some respect has used some form of moving average. And what I would say is generally you want to look for between a 14-day, 20-day, 50-day, and 200 period moving average. And that's pretty much the standards. Obviously, the longer you go back, the smoother the curve is. So a 200-day moving average will be a lot smoother than a 14-day moving average. You have much more peaks and troughs and less data to go off. So I'd say generally, for me, using the moving averages is better round across. So for intraday trading, maybe use your 14 and 20, or your 20-day and 50 cross, and try and figure out what works for you. I wouldn't necessarily just use a moving average on its own. If I was, then I'd just use a Bollinger Band, because a Bollinger Band is just 2 standard deviations around a moving average anyway. So if you're going to use moving average, I would use a combination. So either a 14-day, 20-day, 20-day, 50-day, 50-day, or 200-day, and cross them over. So when the market crosses the moving average, you're then going to see a point of interest, that's going to transpire. The thing to remember with any kind of moving average is it is an average. Okay, so it's a lagging indicator. If that's taking 14 days, 20 days, 50 days, that's a long period in trading terms. So you're not going to just see a close below the moving average and then something's going to happen immediately. You have to factor in time to all these things. As I've said, which I'll pay testament today, trading's not about being right, it's about being right at the right time. Okay, so when things happen in the markets, you've got to be on the right position, ready for the market to take you where it needs to go. Yeah, so you need to preempt these moves. So how's the moving average used? Well, I mean, again, I don't want to be, kind of too rudimentary with these things, but it's an idea of what the market's been doing. So if we're trading constantly above the moving average as we are up until point B, then it shows you that the market, when it breaks out and closes below it, if it doesn't continue to go down, then you still got more buyers than sellers. So as we close above it, the market finds value, okay? And then when we fundamentally do break it, and we see this point in A and the gap, market moves down, then we see that overextended move because, that's getting all the longs out of the market. So really, it's just understanding where we're trading in relativity to some sort of average over the period. So I mean, again, this is a fairly long period chart because we're using a 200 period moving average. So again, the more times we're below it, the more likely we are to go down. But the more times we close above it and go higher, the more likely we have to have buying signals. So, I mean, moving averages don't really tell you much on their own. Again, they're just meant to be a trend line, a guideline of something that's automatically generated based on what's happened in the past. But, I would say a trend line is probably a little bit more useful than a moving average in this scenario. But again, when you've seen this, I'll just draw this in just to be a bit more clear. But if you drew a trend line in this, and you saw that the market was following the moving average, and all these times, we get to the low points and the market bounces back up and gets to these high points. If you're doing something like maybe an Elliott wave, which this could easily be an Elliott wave scenario, when we get to point A and the market closes below the moving average and we see this gap appear, that could be another confirming signal the market's ready for a move, because that'd be the first real down wave of the correction Elliott wave. We've gapped, which is another signal. We've closed significantly below the moving average. So I don't think you'll be able to hold on and sell it all the way down here, but you'd have a good chance at getting short and understanding that's going to be a breakout trade. So how useful that would be, arguable. But again, as I said, it's about using these trend tools and oscillators to enhance your view. So if the market's gone up for, in this period, this is a 200-day moving average, this could be 3 weeks of buying. So by the time we finally come down, you could be thinking, well, do you know what? We're going to have to take some profit at some point and break down. And that moving average, as I said, could just be another indicator that adds to your overall picture. It won't be just the definitive trade call. So the main thing to keep in mind here is the shorter the moving average, the more we're going to see in terms of spikes in volatility. So obviously, the less periods it takes, the more volatile the market will be. And really, again, I'm not trying to over or undersell the moving average. I'm fairly indifferent when it comes to the moving average. It's about as basic as trading tools get. But in some respects, that's good because it means a lot of people use it, and a lot of people then will benefit from the self-fulfilling prophecy that if we continue to close above the moving average, we're going to find strength. Close below, we're going to find weakness, and that's good. That gives you an idea what the majority of traders are out there. So again, it's not going to give you too much of an indication of that much market noise, because if you put the moving average to a 5 period, for instance, then it's just going to be that little bit too volatile. So I'd say it's a good idea for setting the tone for the market and just seeing how the market interacts with it. So if you're going to do something like this, where we've got a 20-day and 50-day, as I suggested before, then really what you're looking for is just these points in the charts where it crosses. So you're not really particularly interested what the market's doing, above or around the moving average. But you can see we've gone from the low to the high here. So as the moving averages cross, we then see the market does get quite aggressive and go bid. When the market crosses the moving averages here, it does then sell some sell signals and go back up. Likewise here. Okay, so again, the markets cross here and we go up. So the moving averages as a cross are probably a bit more useful to understand actual trend changes. So we see the market again go from here, we go up. Market then crosses, it goes back down, crosses. We're already on our way up, but then again has that extra bit of volatility to continue. Then we're going from a down point to an up point when the markets cross here. So it's just something to look out for. Do a 14-day and 20-day or 20-day and 50-day and use them on your charts. And when you see a cross, if that significantly helps you understand if we're ready for a breakout, a continuation or correction, then it's something of use. It doesn't take up a lot of space on your charts. So again, experiment with that. So I said the disadvantage of moving averages is because they're lagging and so severely lagging in most cases, they don't give an exact entry point. They're just warning you of trend reversals and continuations, which isn't a bad thing. You know, that's a good thing to be aware of. And again, as they are lagging, the actual trade and the actual profit that's going to be made could be significantly in the future. So, you know, again, if you're using a 50 and 20-day moving average on an hourly chart, you might have to wait 2 hours after you've seen that cross, or after you've seen something else to actually get in the trade. So again, it's about having that discipline and patience for letting the market do what it needs to do. And so the whole point again of the moving averages is because they're so widely used, they're open to short-term manipulation. So if we've closed below the moving average 20 times, and then all of a sudden you go short and you see the market spike up 20, 30 ticks in a straight line upwards, then you know that's the market trying to get all the weak shorts out before then closing lower and doing exactly what people think. So the moving averages again is another one for understanding how the big traders, how the institutions, whittle out the weak traders by doing something we know that's going to happen. If you've closed below the market 20 candles in a row, and you know that the market's bearish anyway, and then all of a sudden it goes up for no reason, 20, 30 ticks in a straight line, then that's a short squeeze. And then we close below the moving average and the market goes down exactly what you thought. So it's something else to look out for, how other traders view the markets. So Bollinger Bands. So invented by John Bollinger in the 1980s, nothing to do with the champagne, but they are, again, I think you can fall into a false sense of security with Bollinger Bands because it always seemed to work. What you're looking for is generally on the hourly charts, 20-period Bollinger Bands, and looking for significant closes outside the upper and lower bands. Because all they are, again, is that moving average with the upper lower band 2 standard deviations apart. So what you're waiting for is the market to break from the moving average to the up point or to the down point and either continue or reverse, or be trading outside the upper or lower band and waiting for them to reverse. So it's worth noting that markets very rarely stay in a tight range. So when you see markets and Bollinger Bands that are close together, we're ready for a breakout. When they're very far apart, we're looking for consolidation. So that's all that text means. It's better if I show you an example. So it'd be better if I went through some live charting examples, but you can get an idea. I mean, basically, this is showing wherever we poke out of the lower or upper points of the Bollinger Bands, they're the extreme of the market. So treat it very much like RSI, that when the upper band we're oversold, and when the upper band we're overbought, when we're in the lower band we're oversold. So it's looking for the market to get back to parity. So the way I kind of look at Bollinger Bands you've got your moving average. So that's always your first point of call. We're either going to be moving away the moving average, and then we look to get out on the Bollinger Bands, or we're looking for a break of the Bollinger Bands to the upside, and that to be rejected, and then to come back to the moving average. So you're either selling away or buying away from the moving average, or getting involved in these bands here. Your first point is back to the moving average. You think it's still good. Your upper band is the next point. So Bollinger Bands work really well, and they work really well in hindsight. So what you need to be doing is understanding like from here onwards. So we don't know anything that's going to happen to the right hand side. But the market's come down sharply, got back to the moving average, and hasn't got to the upper bands. So we're looking for, again, potential short below the moving average. And we do that, and in 2 candles we get to the lower band. Okay, so you have to understand you don't know what's happening in the future. When you look at Bollinger Bands, it's obvious. Well, I bought here, sold here, bought here and sold here. That's dead easy. All I ever use is Bollinger Bands. But look, that's because it's the benefit of hindsight. What you have to do is predict what's going to happen in the future and how it's going to look. And it's really difficult, actually, because I trade loads of times, like the upper Bollinger Bands here and the lower Bollinger Bands. And like I said, you have to put that element of time in. You can be waiting 4 or 5 hours, and then by the time the trade actually comes, you're exhausted, and you get out for a little profit, and then the market does that, or the market kind of trades down here and then breaks down quickly, in like 4, 5, 6 hours after. So you have to be patient when using Bollinger Bands. You have to be patient and knowing the extremes are just that, the absolute extremes. So you're either trading, from and to the moving average, or from the extremes, back to the moving average. Okay, pretty simple when you think about it. And again, I would generally use 20-period Bollinger Bands rather than having a moving average. So if I had the 20-period Bollinger Bands on, I might just have a 50 period moving average that would just cross like that. So you've already got no need for a moving average because that's setting your Bollinger Bands the midpoint, and your 50 period moving average can just go in between and cross. So again, something else useful to try. So the RSI is a good one. It's one of the more common indicators, and it's more for like modern computer trading. When I say modern, it wasn't really around 10, 15 years ago. It becomes more in fashion as things change. But the RSI is an oscillator, so it moves between 0 and 100. The general rule of thumb is that anything above 70 is overbought, and anything below 30 is oversold. So what I straight away do is I put some tolerance into that. That I know if the majority of market participants are going short when the RSI is at 70, I put some tolerance up to 80. Okay, so I just put my own boundaries. RSI in theory can go from 0 to 100. So just because the market suggests that 70 is overbought doesn't mean it's going to stop there. So you can do it at 75, 25, 70, 30, 80, 85. Depends how extreme you want that market to be. But they're a good solid indicator, and they do work probably 70% of the time. And again, it's the element of about being right. You don't just get to 70 in the RSI and then sell. It might be a couple of hours later before it actually works. So again, just very, very simple to see. The market here is an oversold territory. We're below 30. The market bottoms out, but it takes quite some time. And then we come up, and then it really doesn't get momentum till here. Okay, so we have to wait a long, long time. And it's almost like you've got to follow the RSI up to the midpoint, and then it has a second resurgence. And just the same when it's selling. We get to the oversold territory here, comes down, comes back up, and then we see the real move. Okay, so we wait for that almost like divergence, where the market comes down, peaks up, and then goes down again. And then really this point here, we expected the market to come down, but it's really kind of still looking a little bit positive. So we probably just stay away from that. But what you're trying to do is to get them extremes of the lows and the highs, and for them to work for your trading. So again, it's like saying, right, well, we don't know anything to the right of this line, but we know that the market is going to bring the RSI up, hopefully, because we've just coming out of that oversold territory. And then we wait for the market to come up, but it's not really till here, till we get the oversold territory, we could get out for a maximum profit. So it's trying to use the RSI for your entry and exit, because remember, it's lagging. So you're buying as much as you can till we're oversold. Then you're selling, and you're selling, and you're selling, and you're selling. You're not buying it back till we get to these low points in the RSI, and that doesn't actually get to 30 when the market actually gets to these low points, but it gets low enough. So then you take your profit from here to here. So again, it's not an exact science, but you get the idea of how it works. So RSI again can be shown to use potential divergence. I'm really a fan of divergence, to be honest. The market's too volatile right now for that kind of stuff. But what you just see is the market's moving in an uptrend. Okay, so RSI goes from the low to the high. Yeah, market goes from the low to the high. Go back down, market comes back down. And then we kind of step up and then go up again. So we step up, come down, go back up again. But then the market really continues to go sideways, and the RSI comes down. Okay, so what that really is telling us to this point here is that we've got divergence, that the market really is overbought, but is continuing to keep at the top of the range, and then that means something big is going to happen. So we see the market actually come down. Yeah, it's actually coming down here, but then the RSI immediately goes back up, taking the market up, and that kind of doesn't indicate anything apart from the market's really being really stretched out. So when the market does come down in the RSI, again, it comes down in this weird formation and fashion. But when it does come out, we have one breakdown, one consolidation, and a massive spike. So really what that's trying to tell you is that this whole point between here and here, we see divergence in that we're really kind of moving in a sideways manner, okay? And it's showing that we haven't really finished that uptrend yet, but we're not ready to go down. So the market's just diverging between these points. And it's good because that will signal something big is going to happen in the future. So again, we stay towards the top of the range here. Well, that's signaling when we do have a break to the downside, it's probably going to be a pretty big one. Then in C, when the market, again, is only trading towards the midpoint of the RSI, that one spike down sees this huge sell-off. So divergence really for me is a precursor to a big move happening. When you stop seeing the RSI, peaks and troughs, really correlate with the market peaks and troughs. yeah, then that's when you know that divergence is happening. So parabolic SAR. So parabolic SAR is the stop and reverse signal. It's probably the only indicator that I know of that tries to predict the future. So as I said to you, most indicators are lagging. They take what happens in the past to predict what could potentially happen in the future, but taking previous data, and that lags. The parabolic SAR actually prints a dot in the current time frame to give you an idea of what could happen. Not always that useful, but it is something that again can be used when the markets are in your favor and the markets are ranging, or well, probably more when they're breaking out to give you an idea of changes. Now, the parabolics are again something I've wrestled with for a long time to try and get that exact formula for really sharpening up your RSI or sharpening up other particular indices or particular indicators or things that you trade. Now, how you read them is just a series of dots. So unlike the moving average or the Bollinger Bands, this puts a dot above or below to indicate the price action. So if it's below, the price is going to go up. If it's above, the price is going to come down. Sounds simple. It's because it is simple. And what this shows is that when the market is coming down, the parabolic SAR remains on top. But what I find interesting is the parabolic SAR actually switches across. So in this chart here, yeah, the market is printed dot dot dot, and the market, again, is meant to go up, and we do see, the market's come down slightly, but it's where the market crosses that's interesting because this dot here, yeah, is printed in the future. So as this goes from here to here, which is on this candle here, the market is telling us that that's gone from a bullish mode to a bearish mode, and then from that point onwards, the dots remain above, and the market goes down. And then when we see this final dot here and the market opens up, yeah, the market then again, we see this big green candle that comes in, then every dot is below, pushing the market up. So I don't really ever look at the parabolic SAR dots and say, oh, well, they're all above, so it must be going down. What I'm more interested in is this crossover period, because that's your indicator where the markets go from the high point to the low point or the low point to the high point, and you can see the trend change. So it's a bit of a precursor to what the market's going to do next. So up, then go to down, and you have to be patient again. So what I would say is put your parabolic SAR dots on, and then you're looking for these periods of where the market changes over, okay, or the market again is looking to gain a significant, steepness. The steeper these dots go, okay, the more likely we are to be topping out. So again, the more kind of close they are together, and then the kind of smoother the curve, yeah, the less volatility is, and then the longer the tail in the curve, the more volatility it is. So again, you're trying to follow these parabolic SAR dots up, and it all kicks off and is triggered by this change point here and here. Okay, so just again something to look out for. I'd recommend using them on hourly charts, maybe 15 minutes. You're just looking for that trend change. That's how I would read the parabolic SARs. I wouldn't do any more. I mean, again, you could use these parabolic SARs as trailing stops. That's something else that people do. As you put your trailing stop in because you go along here, and as long as the parabolic SAR is below you, you don't get out. So your trailing stop follows you as you go along. So again, another technique you can use with the parabolic SAR is using a trailing stop to follow you as the market gains direction. So there are disadvantages in the parabolic SAR, especially in quiet periods, because if it's quiet, you don't really see a trend. So you get choppy kind of trading signals. So you'll see, a couple of dots up, a couple of dots down, a couple of dots up, and that's not really what it's meant for. The parabolic SAR is meant to catch that trend change and to ride that wave. So you want to use it in breakout markets and to say, right, well, I've seen 2 or 3 parabolic SARs below now, so I want to see another 5, 6, 7, 8, 9, 10 before I get out of my trade. And again, that's by catching them tops and bottoms, using that change in the parabolic SAR, and then riding the wave. So difficult to do sometimes. And again, when we're trading intraday, it's difficult to know how many parabolic SARs to go off. And that's why, again, you have to go back to your time frames and use maybe a 15-minute chart and an hourly chart to understand what you're trying to achieve, because there's no point in waiting 9 hours for a trade, particularly intraday. Maybe there's a lot more opportunities you can use by trading the smaller time frames and getting in and getting out. But again, it's about balancing the time frames that work for you and understanding what you're trying to get out of trading, what period of trading you want to be. as I've already explained, and understanding what you're trying to get out of trading, what period of trading you want to be. As I've already explained, we're all really just momentum traders, but it's a short-term scalp or a longer-term momentum trade. And again, that's the difference between holding long trades, as in overnights, weeklies, dailies, monthlies, and holding 15-minute trades, hourly trades. It's all relevant. You can make a lot of money in an hour. You can make a lot of money in 3 days. It depends what size you're using and what risk exposure you've got in the market. So Fibonacci retracement. So Fibonacci sequence is named after Leonardo of Pisa. So this is all the kind of Dan Brown, Da Vinci stuff. So the Fibonacci numbers have been around, since time began, pretty much in modern mathematics. Accredited to the Chinese, but it was actually in Indian mathematics around the same time as well. And Leonardo obviously is Italian, so he kind of came up with the drawings that you see of the circle and that kind of stuff. So that's his kind of contribution. And Fibonacci is something that happens in nature, so it's the reason why cells divide the way they do. It's the reason why your forearms same time as your foot. It means that whatever moves in a certain proportion will move in a certain proportion exponentially, going through the sequence. So the one I use is generally the Fibonacci retracement, which I use on all my charts. So this just goes to show that market has gone from a strong directional move from here to here. Okay, so the market's gone up. Yeah, it's made new highs, then it's stopped. 8% of the time, a strong directional move is going to get to 50%. Okay, so that's this line here. So when it gets down, it doesn't make a new high from here, and it gets that 50%. So you can see the market's an area of congestion. It then continues, it closes below, and gets that low point. Okay, we do break below, but don't close below. Then we go back up to the 50%, back down, back to the next fib, back down, back to the next fib. So you can't tell me that Fibonacci retracements do not have a meaning. What you've got to do is find a strong directional move or a significant area of interest and then trade accordingly. So your key levels are really the 50% for me all the time. A lot of people like the 61.8. It works just as well. But what you're looking for is this up move here, once it hasn't made that fresh high, to get back to the 50%. It can only do one or two things then. It's going to go on to make fresh lows if it closes below the 50%, we're going to make fresh highs if it closes above it. So that's what you're looking for, that pivot around that 50%. Okay, and again, time is the key. If it's taken 15 hours to get here, 15 hours to get here, it might take 15 hours to get here. Yeah, or 25 hours, 30 hours to get back to here. But again, it's all about that element of time. Okay, and looking how things move. Yeah, Fibonacci, very powerful. So say the Fibonacci's got the most use in the markets because it doesn't matter if you're a swing trader, momentum trader, whatever. As long as you get that right move, and a lot of people fail with Fibonacci because they don't understand where to draw it. And if you don't draw it on a strong directional move that looks right, then you won't benefit from the self-fulfilling prophecy, and you won't get people buying and selling into that pivot level. So it doesn't matter if it's bond, stock, or FX. If something's moved in a significant manner in one candle, or two or three candles, or over a period of a week, then use that Fibonacci on your hourly time frame or your 15-minute time frame to determine where the boundaries could be. So I could give you a million examples. I could go through charts all day long. Gold. If you take the monthly gold from August 2008 to the high on the monthly chart, okay, you will see that we bounced off that 50% monthly, and from that point on the weekly, daily, and hourly, all we've done is sold off from that point. Okay, so that's an example of using what's happened in the past to predict the future. So trading analysis. So trading analysis is technical analysis. Sorry, is the study of price action. So very much like we've gone through the oscillators just then. Then what we're trying to understand is the whole part of technical analysis. And as I said, it's 80% of trading for me. It doesn't matter if you're a day trader, you're a hedge fund manager, or whatever. You use technical analysis because you have to justify, trading. And people justify trading by saying, well, I've seen this, I've seen that, I'm trading up this and that. It's quantifiable. And that's why people like technical analysis, because it's reasons, isn't it? Something's either too high or too low. Something's moved in a certain manner. A candlestick has shown this formation. The whole point of technical analysis is 80% of trading because there's just so much more of it. Okay, when we talk about fundamentals, there are key comments, figures, and things that move the markets. But then there's umpteen, literally infinite things that people can justify for technical analysis. And whatever you look at for technical analysis might be what I look at. So the whole point when I went through the oscillators before is I went through the basics and the ones that the majority of people, the vast majority of the market would use. So your Fibonacci, your moving averages, your RSI, maybe your Parabolic SAR and Bollinger Bands. They're the kind of staple of your average trader out there. So as long as you're looking at them, you've got an idea of what technical analysis is doing in the market. So the advantage of technical analysis is more objective way of trading. So you can set your stops around it, your risk around it. You can build a trading plan all around the technicals, and it can be an and, if, it can be if an X, Y, and Z. Again, the more things that you have that strengthen your argument to trade, the more confident you'll be. Difficult part is knowing when to stop. There's no point having 10 indicators running to give you one trading signal. That's just too many. They'll contradict each other. So I think the perfect combination is somewhere between 2 and 5, and that's for you to find out. I use between 2 and 5 indicators, but then I'm using them spread over different time frames. So I'm only really using maybe hourly Bollinger Bands, hourly candles with hourly RSI based upon 15-minute Fibonacci's, and that works for me. And again, depends on the market conditions. And it will give you an exact entry point, unlike fundamental, where you're just buying and selling based upon news and comments. Your technical indicators will tell you where to get in, where to get out. I bought the Aussie CAD on the back of the comments, and I knew where it was going to go technically, but it didn't move quick enough for me. And that's what you want. You want that fundamental to move in the technical manner quickly to give you that confidence to stay in. And it didn't, so I got out early, and subsequently, went up another 35 ticks. But just the way it goes, isn't it? Just the way it is sometimes. It's marrying up them fundamentals and technicals and just trying to make the most out of it. So obviously the disadvantage of technical analysis, it doesn't tell you why things happen. And that's, again, another key thing to remember when you're looking at the Bollinger Bands or moving averages. If you see something that happens out of the ordinary, and if you're expecting the market to go short and it just goes up for no reason, then that's generally a technical squeeze. So if you listen to your squawk or you don't see anything on the news wires and the market's moved, then what you need to do is average and be aggressive with that trade. Because why has it happened? Yeah, if it's just moving because somebody's decided to jump in and buy 1,000 lots in the FTSE and send that up 20 ticks and none of the other markets have moved, then maybe that's a technical squeeze and you can use that to your advantage. So that's just the other way of marrying up the technicals and the fundamentals. The market moves for no reason, then it's probably a squeeze. If there's no justification for it to move and all the market moves, then you have to be aware of that. So, obviously the fundamentals are driving the markets right now. And any kind of comment seems to be making the markets pretty wild. Well, you'll generally hear about them on Twitter, on Bloomberg, Reuters, anywhere. And if you do hear them, then you can react. If you don't hear them, then generally that's just a technical squeeze. So all the things we're looking at when we talk about technical analysis is candlesticks, market profile, volume, open interest, trend lines, trend channels. The list goes on. We could sit here and literally talk for hours and hours and hours about all the different types of technical analysis, their benefits, their merits, their disadvantages. I've got people that talk about high Fibonacci candles. I've got people that talk about, various, crazy moving averages, and all these kind of different things. And it's absolutely fine. I think I like technical analysis because I understand people, understand how traders work, and I use the obvious technical analysis in an obvious way to see when people are right or wrong. So if the majority of people are looking at a moving average to tell them X, Y, and Z, and it's doing the opposite, then again, I can go against them because they're wrong. When they're right, I can go with them. So I use technical analysis in that way to understand what the big boys might do in order to get the retail traders out and try and profit upon that. So I don't really kind of want to go into that. There's a different style of trading right now, but what we're trying to understand is that majority, I'd say probably 90% plus of people out there will look at candlesticks. So you trade using candlesticks. So Japanese candlesticks have been around for a long, long time now, and they're just good because they're very visual. Every time you see a professional trader being interviewed on the news, they've always got a Bloomberg chart, a line chart. But that's if you're trading, a little bit longer term, and you're trading off, just direction, and you're not necessarily trading off, your technical levels of support and resistance, just waiting for something to go up a long way or down a long way. And again, that's all time relevant, and you have to be a certain type of trader to look at that way. So I wouldn't recommend looking at line charts. Bar charts, yeah, you can use them, but why not have candles that show you green for buying, red for selling, and each individual candle potentially could be its own signal in its own right. So for me, it's just the most value way of presenting you information. You get more bang for your buck with candlesticks. You just get to see more right there and then, and that's why candlesticks are the best way to use. And candlestick patterns are literally whole books on candlestick patterns. So you can do individual candles, formation patterns. There's literally a million things you can go through. So candlesticks are just as simple as this. You've got the body, okay, that show you buying, selling action, and then the wicks. So the wicks are good to look out for. If you see a big wick like this, then that shows you that there's been a lot of volatility, but not everyone's traded, at that price. So I like to see the big wicks and small bodies, and that can be like a nice reversal pattern. So green's buying, red selling. It's as simple as that. So pay attention to anything with a very long wick on the high or the low side and a very small body, or a very big body that has very, very small wicks. That's really what you're looking for. And that's an example where you can use your Fibonacci. Again, if you see a massive spike on the wick and then nothing's happened, then use that 50%, see what that candle can do next. If it's a big green candle, just go from the high to the low. Same with the red ones. So reading a candlestick, again, it's not that difficult really. Green is for buying, red is for selling. What you're looking for, again, is that change. So we've seen a lot of selling action here. And as I've said to you, the momentum generally kicks in towards the end. So we see that big sell-off. And then, there's no point selling at this point. What you're looking for is a reversal. So this kind of hammer formation here at the bottom. So that's 1, 2, 3, 4, 5, for argument's sake, call that 8, selling candles. That's nearly red. And then we see a reversal signal here. The market then shows indecision, and then we see 3 more green candles. The market goes up. So it could be as simple as using that kind of pattern and formation to figure out what the market's trying to do. So the Doji is the most popular individual candlestick pattern. It shows indecision. So it shows the market not being able to push one way or another. And we can see wicks are generally the same size on the low and the high, and we've just got the candle body that is nothing, just a line. So that's just showing indecision. So at the bottom of the range here, indecision, market doesn't go down, well then it goes up. Okay, can be as simple as that. The engulfing, again, we've seen a good solid green day, fairly small wicks, and then the next candle takes out the lows and the highs, and completely the body engulfs that entire candle. Okay, so that's a two candlestick pattern formation. And again, it's a bearish pattern. No matter what happened in the market trading here, it was completely taken out by the next candle, meaning the market should generally go down after that. So again, something to look out for. You don't actually see them that often. And then we've got shooting star, and that's just, again, a trend reversal. So we've seen these nice 3 green candles making new highs. The market attempts to move up, can't. So we see that wick indicating we've run out of up momentum, and that red body here showing the market, again, is closed that candle lower, and then we're going to move down after that from the top of the range. So a shooting star, opposite of a hanging man, and it's in the top of a range and is a reversal. So the hanging man or the hammer is just the opposite way around. So we see the downward selling movement here. The market rejects the low point with the wick. You see the green body. The market from this point should go up. And again, it's all time relevant. The longer the market's gone down, the sharper the up move should be. Okay, so again, put your element of time into these things. And don't do them on minute candles. Use them on 15-minute, hourly, 4-hourly, and daily. Because you're not going to get these great signals on the small time frame charts. So 15-minute and above. Then we've got bearish harami pattern, not seen too often. And this is, again, not a doji, but we've got indecision. The market is at the top of the range, but it's got a wick that can't go up, a wick that can't go down, and it's showing the opposite color of the market that we see here, which is, the market's moved up, and we're right in the middle of the range, don't know what to do, can't go up, can't go down. So this is generally, again, seen to be a reversal bearish pattern. The market couldn't make fresh highs, it's indecision, it hasn't made new lows yet, but the likelihood is with that red candle closing as it is, we're going to move down. And then the opposite, bullish harami, you just look for the same thing. So it's important to see these are very technical, and in that you cannot make a new low. So in this down point here, the harami pattern has to still be in the previous candle's body, which it is. So it can't make a new low, can't make a new high. It has to be equidistant for the or equal lengths of the wick on the high and the low side, and the body has to be not perfectly square, but it has to be relatively in line and relatively the same proportions to the upper and lower wick. Once we see that and it doesn't make that new low here, then that really is just anticipating the market to build up momentum and to break the highs and go back into the range. So candlestick patterns are, again, a lot more significant, and they're generally a combination of the fundamentals and technicals, because when you see patterns and trend patterns, they generally consist of gaps. So again, if you're doing a reversal pattern, again, what you're looking for is the overall trend. The overall trend here is down. So you can see plenty of red candles, only one green candle. Then we see the market try and consolidate here, really. And we're seeing that indecision, okay, them long equal distance wicks, low bodies. Then the market shows this hammer formation here. And this time, it's at the bottom. It's not red, it's green. But then from this point, the market doesn't really look back. So you've got the rejection of the move down with this lower shadow. You've then seen this close as a bullish hammer. It's bullish because it's green. Yeah, we're at the bottom of the downtrend here, so the market really has only got an opportunity to move higher. Okay, so it's using three kind of combinations. Bottom of a downtrend leading into indecision. Yeah, the lower shadow that's rejected moving lower and closed back into the range. Got that bullish hammer single candle formation, and then the market from this point hesitates, okay, for a couple of candles, but then moves up in a steady manner. So again, not perfect, but an idea that the market's gone down, consolidated, shown that it's rejected the low point here, and then moved up, for as long as the move has moved down, it's moved up in a kind of structured manner, making these, moves upwards. So again, that is technical analysis in a nutshell. So continuation patterns, again, things you see on the higher time frames and maybe the hourly charts. But we just see the market moving up and again runs out of momentum, but it doesn't really do much. It consolidates to a peak. I mean, these are like your pennants and your triangles. And what it doesn't do is make significant lows. And you can do your Fibonacci. So you do your Fibonacci from your low point to your high point here. So it doesn't get to that 50%. Then staying above it, it's going to make a new high. So consolidate, consolidate, consolidate. Market then breaks out, and we see two green candles, which will break your high point here of the fib. Okay, so pretty simple, really. Again, continuation patterns are just that. They move in a consolidated way, generally telling that the trend is going to continue because it hasn't gone back to break that trend. And when it does finally break out, you see that momentum you see here continued. It goes on to make new highs. So these patterns, again, are better on your maybe hourly charts, 15-minute. But you can use one on your dailies. Again, if you've seen this reaction and nothing sold the market down, then it's going to have to continue the trend and go back up. So again, it's using periods of time to figure out what the trend has done and what it's going to do. So support and resistance are just that, support and resistance. A support point is where the price is falling and the market doesn't fall any further. Resistance where the market has been buying and can't get it higher. They're important because they're far and away the most used point in trading. And very, very difficult, isn't it, to have a robust way of using support and resistance. But generally, you can use line of sight, previous highs, previous closes. And again, I use the old time frame method. So I go from the highest point that I can on the monthly, of being points of attraction, with support and resistance. Do that on the monthly, daily, on the weekly, and then put that on my smaller time frame charts. So I get a framework. So again, it's the whole point of finding what was support and resistance in the past, seeing where it can be in the future. So again, it just works like this, doesn't it? You get to resistance, the market comes down, support, it goes up. I mean, you need a chart really to show it. But the whole point is, when the market is moving in a uniformed way, it'll do it a number of times. So support is support because it's generally two or more. Resistance because it's hit the same point two or more. So it has to be two or more, and it can be a straight line support or resistance. It can be an angle of support and resistance. This is where your trend channels, your pennants, all these other things come into play. Because support is support, okay? And resistance is resistance. It doesn't matter how steep the line is or what it is. If you find 2 points that connect, that's support. 2 points at the top, that's resistance. It can be a trend channel like this, but as long as you see candles coming down and stopping 2 or 3 times, that's support or resistance. Yeah, it just works the same way. Yeah, that's how it works 2 or more times. It's just the rule of thumb, and that is support or resistance. It doesn't matter what the trend is. Again, it's just about finding things that tie up. So looking at the chart, it's much more easy. I would say this is a good line of support. Okay, so the market, okay, has moved up and is coming back down, but that is moving, very nicely. Every time we hit it, we're coming down, making these lower highs, but the market's coming back to the same point. So when it breaks it, it goes the same distance it's gone from here to here, down. So again, you're using that plain line of sight as a support and resistance. Then moving forward, you don't really know what's going to happen. But you see, this is a good area of support. So if it breaks down, yeah, they want to be selling down to a lower point. Then it gets back to the upper point, down and up. So again, you're just following what's happened in the past to predict what can happen in the future. And again, that's all it is. All it is, just again, using the movement of charts to get involved. So again, draw that line in and keep it. Draw that line in and keep it. Draw this line and keep it. And use it in the future. So again, when we get below it, sell back down. When we can't break below it, buy it back up. Sell it. Buy it. I mean, it's pretty much that simple. And I think line of sight, is a very good way. A very good way of doing it. But you can then pick significant high points that match up, or turning points like this, where the market has gone rejection, 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 and then we see this technical move where the market hits it, then opens up the next candle, and then goes down on the same point. So there's lots of different ways of doing it, but then project these lines into the future and use them in the future. Once you put it on your chart, it should be something you use in the future, or it's not a valid line of support and resistance used for your trading. So the key to knowing whether support and resistance is going to break or bounce, again, is understanding the market and the oscillators. Markets, you're going to use support and resistance in one or two ways. They're going to break the levels or bounce off the levels. So if the market goes up very, very aggressively, like this in two candles, then what's the chance of it getting to an upper level here and actually breaking it? It's more likely to bounce. So again, you have to look at the way it's done, but you've got a level up here and the market's done this, and then it consolidates and does this and this and this and hasn't come down, it's quite likely to break it, isn't it? So you have to look at the formation of the market before it gets to these levels. Look at the size of the candles, the trend of the market. There's more volatility, more action in the market, more people trading, then levels are more likely to break. And if they come a long way in a very short period of time, they're more likely to bounce. Okay, so it's all about understanding what the market's been before it gets to these levels as to what it's going to do. So if you're trading a breakout is just looking for these levels of support and resistance to break. So an uptrend, you're looking for resistance, not to act as resistance, but to act as a breakout point. And when a market's heavily falling down and breaking through support, you're looking for break levels. And again, what I like to do when I'm trading this way is you look for levels that are close together. Okay, so you've got two levels close together here, then a third one, and the market's coming down aggressively like this. Then you think, well, it's probably not going to just stop and bounce to these levels if it's aggressive. It'll try and push through the next logical level and then a bit more and then go back up, because that's how the institutional traders work. So look for levels that are closer together and key levels, psychological levels, bigger time frame levels, and give yourself that tolerance, because generally, the faster the markets move, the more likely they are to break them. So again, a trend line is just any point, be it straight, be it horizontal, well, so straight as horizontal, isn't it? But be it vertical, diagonal, all that kind of stuff. Doesn't matter what the trend line looks like. Again, it can be straight, it can be your triangle, your pennant. It shouldn't really be more than about a 45-degree angle. But whatever it looks like, it's got to connect two or more points, or else it's not a valid point of support and resistance. And that's only the real general rule of thumb. There isn't really much else about that. A support resistance line, the more than the minimum of 2 and 3, some people say, but 2 is, if you want to be aggressive, it's 2. 3 is more of a confirmation, and then after that, it's just as many times as you want. But again, there's no real exact science with that. And again, what I would say is that for me, it's all about being proactive. So I know the market's consolidated here, and then from this point to this point, the market's gone up. Okay, I don't know anything that's going to happen here to the right of the chart. But if you're waiting for the third point, you're not going to know that's a trend line till here. So you're going to miss out on all this action. So for me, yeah, it's a safer way to trade, but I'm matching these 2 points here, and then I'm extending that line. Okay, so as I say, I don't know anything past point B. I know that is potentially a trend. So I extend my line through here, and I look for it to start acting as support. Yeah, and as it does, yeah, you can buy into these areas here and be aggressive. So Again, bone of contention. Some people do this differently. The fact of the matter is, once we connect to them 3 points, it is a trend. It does gain in momentum. But if you're just going off the 3 points, then all this here, is lost potential buying areas. You could even look at this as an Elliott wave. The market comes up, comes back down, but not to the 50%, and then we see this strong buying. Market comes down and then continues back up. So again, that could be a trend, using the Elliott wave. It doesn't matter. As I said, line of sight is very powerful, and just matching up 2 or more points in time that seem to have significance will, generally benefit from the self-fulfilling prophecy. If you're looking for a trend line to break, again, what we see is the market moving in a very uniform fashion. So we're seeing, kind of for every upward reaction, there's a downward reaction. Yeah, pretty much the same. So it's showing the market is moving, in a very conformed way. But as we get down to the low point, yeah, the market doesn't continue lower. Then we see 1, 2, 3 candles. But then instead of that market coming back down in the same way it did on the top, yeah, it's stopped here and hasn't come any further than it's broke up from the top. So again, by not doing what it did in the past, yeah, kind of low and high being the same, low and high being the same, when it does break out, it doesn't do the same thing and it goes up. So again, another thing to look out for. So you can make a trend line in any time frame, but don't rely on trend lines too much. Your risk reward when trading is pretty much everything. Trend lines can be broken. Trend lines can be, held 50 times before they're broken. And there's no real set rule of thumb. And again, use different time frames for your trend lines and try and get a good gauge of where the market's trying to go. Trend lines, straight trend lines are probably the best. I don't really use too many diagonal trend lines personally, because I'm more interested in kind of the Fibonacci, the highs and the lows. But again, it's down to you to figure out what's best for you. All right, guys, well, that's the Trade for Life course completed. Okay, that is all the things we need to know all the way from start to finish, all the different ideas. Is there any final thoughts, anything you'd like to ask, any questions we've got on that? Again, the kind of technical stuff, there's a lot more to it, so do look out for all the rest of my webinars on Fibonacci, Bollinger Bands, Candlesticks. There's literally so much we can still go through in much more detail, but these are all the ideas of things you have to look at. These are things you have to be aware of when you're trading. How much risk per trade do you recommend? Well, I guess it depends, Andrew, on how much you're looking to make. So I generally do it on risk reward ratio. So if you're looking to make 10 ticks out of a trade, then maybe you can only risk 3 or 5. If you want to put it in monetary terms, if you're looking to make like £100 out of a trade, then generally you can only risk £40. So try and keep it on your 2-to-1 type scenario. So 2 times what you're making versus what you're losing. So if you do that, even if you lose every other trade, then you're still going to be profitable as a trader. So I mean, again, you either do it monetary or you do it, kind of reward ratio. So tick to make X amount of ticks, X money to make X amount of money, or a proportion of your capital, I guess. Yes, Joseph. There's in the Omnovia. I'll just in the archive. I'll just get it up now. In the archive, there is literally tens of presentations on Fibonacci. So yeah, there's Fibonacci with Bollinger Bands, Fibonacci with Candlesticks, Fibonacci and all sorts. So if you go into the archives here, there will be lots and lots of presentations on Fibonacci. And again, look at my Google me, Google iView charts, Google find me on YouTube, and there's lots of videos about me, my trading styles and Fibonacci, because I use Fibonacci in pretty much everything. Okay, guys, anything else? Any other final comments? Anything we'd like to add? No? All right, guys, well, listen, there's plenty more coming up. There's plenty more webinars and new material, and there's a whole new kind of additional course after this, which is all about the kind of more finessing parts of trading, the kind of the art of trading. This is just the good standard things you need to know to get yourself involved with the markets fairly safely. Okay, Adam, no worries. Well, remember, everything's recorded. So, just do go back to that Omnovia archives and just look for TFL, Trade for Life 2015. And keep coming to the webinars every Thursday. and keep going to the live trading sessions. And it'll take time. It obviously does take time. There's no point in trying to rush these things. You have to be a little bit patient and learn your craft. It's a difficult thing. You wouldn't just go on a golf course with a set of clubs and expect to go around in par, would you? So these things do take a lot of time. Okay, Joseph, the next live session is Thursday at 8 o'clock. They're always the same. The book's out soon, Peter. Again, just still working away on the final edit. It will get done. It will get done. It's just massively time consuming. So about 8,000 words out of 27,000 words of the final edit. So I reckon about 3 weeks before it's back with the publisher to be given the final okay and out. So hopefully a couple of months, Peter. And that there will be some Fibonacci in that, of course. So there will be some Fibonacci. All right, guys, listen, well, that's been an absolute pleasure, and I hope you've enjoyed it, and I hope you've got something out of it. So do join me at 8 o'clock on Thursday for the next webinar, and it's been great. Cheers, guys. Have a great night.